Earlier this year, the story was all about operating leverage, margin expansion. What is going to be the key theme this earnings season?
Well, thanks for having me on this morning. Yeah, look, I think this is shaping up to be probably the most important earnings season really since the recovery began. And yeah, three words, right? Inflation, inflation, inflation. I mean, I think the inflation narrative has really creeped in to the equity market story. And I think investors are really going to be looking for signs that input cost pressures, being wage pressures, supply chain bottlenecks, or commodity price pressures, whether there's light at the end of the tunnel in terms of some of those costs we're citing, or whether or not we're in for the longer haul. And I think that if this long duration inflation narrative gets legs, if you will, after this earnings season, that that's going to be problematic for equity prices, at least in the near term. So I think that's going to be the focus. And I know that's where we're going to be placing all of our focus as well.
Well, in terms of those input cost pressures, inflationary pressures more broadly, to what extent do you think companies will have been able to pass it on to their end users in the form of higher prices? And is pricing power a differentiating feature that you're looking out for when thinking about what companies to play right now?
Yeah, absolutely. So, I mean, some companies, the answer is yes. And then obviously some companies, the answer is no. And I think that's going to be a big part of what investors are looking for. I think it's something that's important to keep in mind. I mean, inflation is very value destructive for equities because it's very difficult for companies to fully push those costs through. And because you not only have the actual input costs themselves, but then you have capital costs as well. So if you want to maintain a steady return on capital, oftentimes you have to push prices actually higher than what the inflation would imply to actually maintain a steady return on capital, which is very difficult to do. So I think absolutely wide moat businesses that have pricing power will do relatively better than companies that don't. Capital light business models will do better than asset intensive business models. So I think that's important. I would argue though that a better way to try to survive this environment, because look, I mean, it's tricky, right? Because you've got 1.6% nominal bond yields like on the 10-year in the United States, and you have double-digit nominal GDP growth. That's an environment where you want to own assets that have cash flows tied to the real economy, which means you want to own equities. But as you said, you've got all these inflation pressures that are also a worry. So what we've been saying is you really want to own assets that are so misunderstood today that what will matter in 5 years for the investment outcome is not the macro factors of inflation and interest rates as much is how correct your thesis was on how mispriced it was today. So I think really looking for deeply misunderstood situations is another great way to invest in this environment.
Give us an idea of what sectors, and if you can, what companies are misunderstood by markets that you think will do well over the next 6 to 12 months or even longer.
Yeah, so I'll give you a couple. So generally speaking, I think smaller misunderstood tech. So not the big headline names that everybody talks about, but smaller misunderstood tech where there's a misunderstanding around the total addressable market and even the earning power these companies actually possess, because maybe a lot of the costs that are being expensed are actually better termed to be investment expenses. So there's just a misunderstanding around the growth potential and the actual the earning power of the businesses. So an area that we like a lot is the observability space. So these are companies that provide platforms that allow their customers to monitor their entire technology stack, be it infrastructure, application software, in real time, ingest data and get useful insights that will help them improve DevOps, user experience, even security. And we think the total addressable market for these businesses right now is probably under about 20 billion, but we see that growing to close to 45 billion by the middle of the decade. And two companies we like specifically in the space, Splunk and New Relic, we think are both misunderstood, not only from a TAM perspective, but also they've both recently changed their pricing models. And I think that the pricing model changes have really kind of fouled up the GAAP financials in terms of really reflecting the growth potential and the earnings and the return potentials for the businesses. So that's one area that we like a lot that we think is just not fully understood by the market. Most people don't even know what observability really is. So that's one area that we like that we're doing a lot of work in.